Hey, Howard, welcome back to the show.
Thank you. Thank you for having me back.
So, for anyone who maybe missed our first conversation, can you give everybody a quick version of your background? I know from our last recording, you were MIT engineering, Goldman Sachs, led an ETF business in PIMCO, and then, founded Kurv. Can you just walk us through that journey a little bit?
Yeah, where we are at Curve is very much trying to find a solution to a problem. We were running a lot of institutional strategies for sovereign wealth funds, pension funds, and endowments. And a lot of these strategies, sophisticated institutional strategies, were really not available to people who have a brokerage account. So the idea for Curve was very much how do we wrap these strategies that have actually generated quite a bit of performance for a lot of these endowment and pension funds type investors, and then make it available for anybody who has a brokerage account. So that's the genesis of Curve. And when we actually came on this channel 2 years ago, exactly 2 years, because we're celebrating the second anniversary of KQQQ. That was our very first basket idea in a particular sector. Now I am happy to report, I think when we were first on, we were talking about a theory, financial, like how we would work. And now we have 2 years of history that performance that I've actually proven out those theories that we have been managing, applying the same techniques we have with these large institutional clients to an ETF.
Yeah, that's what I was going to say. Since we last spoke, you guys have grown a lot. You've got new funds, new strategies. Can you kind of just give me the overall state of the firm today and kind of what you're focused on at the moment?
Yeah, we pretty much stuck to our core and try to maybe think about it like a tech company where what is the problem, what is the use case, and how can we resolve it? A lot of myself have a background in asset allocation. A lot of team members came from PIMCO and other large, asset managers. And we, through our careers, have seen a lot of trade-offs that investors and advisors have to make, and we try to make solutions for that. One of the biggest challenges, and especially now, is this trade-off that investors have to have between growth and income. So, now almost a decade before, when we were in a zero rate environment where people were not expecting any yield from fixed income. And unfortunately, I think in the environment that we're in, more and more people are needing to depend on investment income, whether approaching retirement or during retirement, to offset either negative cash flow or just simply, needing more from beyond what they have in paycheck. And
Oh, please go ahead. No, please.
And there are lots of assets that you want to own, but don't generate income, right? So for example, growth stocks, which has been larger and larger, a part of indices. We've talked about that in people's portfolios, but it's kind of an exposure you can't escape, right? That's where, if you look at the S&P 500, it's really the tech companies who have positive earnings versus more traditional consumer staples. They're actually relatively flat as a performance or actually slightly negative, right? But the problem is that growth stocks don't distribute dividends. Because of their return of investment is so high, they either reinvest it back into the company or they do stock buyback. Or there are other asset classes which we have moved now. It's like, so precious metals like gold and silver, right? Bonds, as we know, is less and less good of a hedge in a portfolio because that negative correlation between equities and bonds is, less negative. So other assets that are more negatively correlated with equities are providing better hedges in a portfolio, but there also precious metals do not provide income. So we're really trying to figure out ways in where these are really anchors in people's portfolios that we think you should have going forward, and how do you build an income portfolio out of that?
Interesting. So let's just get right into your newest fund. It's I'm going to call it KMEM, KMEM, the Kurv Memory Select ETF. You guys launched this recently on July 1st. At a high level, what is this fund? And as you alluded to earlier, what problem are you trying to solve here?
Yeah, so unless you're sitting on a cave in Mars, this AI build out has been in the news for not just the last year, but the last 4 or 5 years, right? And initially, the problem was compute. everybody was going after NVIDIA because these models requires huge amounts of calculation. That was the original bottleneck. And what we did was we tried to see where are the bottlenecks that are coming next. Because if we, somebody on our team says, if you take an extreme scenario, right? If all of human knowledge, which is not true, can be encapsulated in ones and zeros, like what would you need? You actually need natural resources and there's physical constraints and things, right? So we as investors tend to look a little bit forward and say, what are the next bottleneck? And I don't know if you recall, there were a couple of years ago, there was like this article on the New York Times where a reporter started talking to ChatGPT, and he talked to the model for like an hour or two, and it went to very weird places where it, I think at the end, confessed love to him, something like that. And that was a common effect called a hallucination. And the reason is because when you ask the model a question, it doesn't remember the previous question that you asked, so it has no context. It's answering your question as if it was like a new question every time. And fortunately, I think most of the models have left this hallucinated stage. But the reason why they're able to fix this problem is because they have actually put in more memory into the models so that the models are able to retain past histories of your conversation. So just like you're talking to a friend, you have history, so it can better answer your question over time. And that is made possible because of memory chips. And in fact, it's not just the models. It's even NVIDIA's motherboard requires more memories to be accessed in order to actually help the compute as well as all of these data centers are being built. They require servers requires a lot of memory. So this is what we feel was a really big bottleneck in the AI built out. And so that's why we launched KMEM as a dedicated focus, an investment case for that particular segment.
Yeah, so we've had a lot of tech-focused ETFs on the show recently, and the phrase I keep hearing over and over again is the picks and shovels, but you really referred to KMEM as the mines instead of the picks and shovels of the AI trade. So can you walk us through that framing and why memory chips specifically sit at the heart of any AI build-out right now?
Yeah, the reason is because there's a limited supply. And if you know about gold, silver, and copper, we also have this issue where we have limited mines where we can get stuff out of the ground. And the reason is that most people don't know that 90% of the memory chips in the world is actually made by 3 companies. The first one is Micron. The second is a division of Samsung. And the third is SK Hynix, another Korean company. And so they make most of the memory chips because before this built out, memory chips was actually fairly commoditized. There's no differentiation. Micron has been around a lot, but a lot of their market share was taken by Korean companies, Samsung and SK Hynix, because what they were making is so commoditized that somebody who comes in with a lower price can undercut the volume that they were selling. But with the AI build out, they're actually creating a moat around their business. They're creating these specialized chips called HBMs, which is specifically their memory is essentially stacked on top of each other. That gives more capacity to the AI build out. So they have actually, going back to the mine analogy, they have sold out most of their inventories up to 2028. So people's like, well, if their demand is so big, why don't you just make more, right? But the problem is that this is the physical constraint I was mentioning about. You hit a physical limit. In order to make more chips, you need more fabrications, factories. They take 30 to 50 billion of a facility to build out, right? And they take time, physical labor to build out, the factories, etc. And then there's additional bottlenecks. Okay, now you have the factories that's in place, but you need the equipment to make these chips, right? So a lot of these use very high-end technology like the lithography, which another bottleneck is only one company in the world that makes that, is ASML, a Dutch company, and they already have years of wait list to get their equipment. So all of these really distinct bottlenecks makes it impossible to increase supply, at least in the near term. We actually think this bottleneck is a 2 to 4 year thesis. That's why even, I think the elephant in the room is like we've had a good big correction in semiconductors. Why is this still interesting? Is that because this constraint is going out 2 to 4 years, we see this actually continue to be an investment case. The reason is because you've actually seen that these memory companies who used to make commoditized products actually have pricing power. So SK Hynix just reported earnings. Their revenue went up 250% and their profit went up 500%. Right? So they are price setters instead of price takers before into the market, right? Of course, there's other incumbencies that are coming in, Chinese company, which what I think caused a little bit of the pullback, but how they're setting the prices for their chip is at the same level as the Korean company. So it's not a cheaper alternative that people thought it was going to be. But I also want to mention there's a secondary effect. So I'm sure everybody's heard of, Apple raising prices for their products, MacBooks, iPhones, Xbox raised prices. All of these consumer products are raising prices because memory chips cost has gone up. There's a secondary effect, which is that because these three companies, Samsung, SK Hynix, Micron, want to build the memory chip that has the moat, it's actually crowding out them making out commoditized memory chips. So there's another bottleneck in just consumer electronics in terms of all of these productions. So I think this actually has implications for many parts of the portfolio. So we think this actually is a very interesting space for people to continue to look at, despite we actually think the pullback is actually a good entry point into this particular space.
Well, Howard, you just put about 50 different questions in my head. You and I could talk for probably 2.5 hours on this. Let's try to boil down on a couple of things you just said there. One of the things you just said was you think that this bottleneck could last, a couple of years, right? 3-4 years. What data points are you guys looking at internally that would change that view? Like what would make you say, okay, is it just pure supply? What would make you change that view, or what would signal to you that the supply is starting to broaden and we could see advancement and growth in this area instead of a constraint?
Yeah, there's always risks in investment. So there's a few things that we look about. So obviously the first thing is the CapEx for hyperscalers, right? In fact, it's very indicative of, whenever there's an announcement or earnings call, which we just went through for Google, etc., they said they've increased their CapEx. That's actually good for memory companies because what they have cash outflows to spend is cash inflows for these memory chip companies. I do think that, one thing is, we need to look at how much they're spending in terms of building out these capacities, but it's not a risk, it's not a fear case. It's how much of the backlog are they going to be able to resolve? Because many of these memory chips, again, as I've mentioned, has already 2-year, 3-year backlog on orders. And then if you look at the hyperscalers, when they say they have another 2-3 years of compute backlog for people who want to use this, right? So there is this chain effect that ultimately happens. So we think that if there is increased supply or slower demand from the hyperscaler, it's just going to compress the backlog, but they're still going to have pricing power. The other thing that we are monitoring also is new entrants in the space. There is a behavior in semiconductors where in the past, we've seen this in the 90s and 2000s where, semiconductor chips become really hot. A lot of new entrants come in, underprice the existing incumbent. And in fact, that's what a lot of the Korean companies did to Micron. Micron was like the incumbent in memory chips. And then most of memory chip production moved to Asia because they were actually able to produce it at a lower cost and undercut it because it was a commoditized product, right? But I think in this cycle is a little bit different because we've seen a bifurcation in the market. There are large, capable companies, the three companies who have the capital to focus on the specialized chips. And that's very much dependent on the hyperscalers and their spend. And then they're moving out of the commoditized product, but there's still a bottleneck there. So really what we're looking at is new entrants and also in the commoditized space, because that feeds into everything we do. And another example is, I don't know if people recall, during COVID, car prices went up. Not because there wasn't enough metals to make, but because there were not enough memory chips in the cars to actually make what, cars are really just like computers on wheels nowadays, right? So, so those things will filter out actually to more of the broader economy. So that's another thing that we take a look at. And we think there's probably still going to be this cycle in semiconductors, but the peak and the trough are flattened a little bit more because there's more products and the need is so much greater. There's also upside risk. The next hottest thing is sort of robotics, right? How do we automate? Those also require memory. So there could be competing demands offsetting those of the hyperscaler. So I would just say that there are risks definitely, but the space is so dynamic right now. I think we're kind of in this innovation push. The 1900s industrial revolution was sort of this innovation push. I think we're kind of in that other cycle. So risk doesn't always have to be downside. It could be an upside case. So we're kind of monitoring that space quite closely.
So I was looking at the holdings, as you've mentioned a few times, the big three. The portfolio is about 85% concentrated in those three deliberately. Talk us through why maybe not getting diversified a little bit downstream, because it seems like there's downstream opportunities to feed these three companies. Why the deliberates of really that heavy conviction and concentration in those big three names?
We started the portfolio the portfolio name is actually Memory Select, and Select is for us, the nomenclature is a more concentrated positioning, because we don't want the fund to be, there are other strategies that, by the hyperscaler as well, because they're a consumer of memory. So we want to really focus on the sector of people who make the memory chips. And because the top three companies, Micron, SK Hynix, and Samsung, captures 90%, you'll see a larger exposure. But I will say, actually, as prices move and things become cheaper, we've actually moved into other names. For instance, SanDisk, which also makes another form of memory. And then this is actually the thing maybe also worth mentioning is that there are many different types of memories. There's NAND memories, there's solid state. There's also storage memory that Western Digital and Seagate, there's a big thing in the 90s, you go to Fry's and get like these 2 terabyte storage. All of these are being eaten up because all of these are different parts of the data center and AI infrastructure built out. So what we felt was there was most pricing power in the top three. But as things become cheaper and as market has pulled back, we've actually seen some other cheaper names that we're actually also reallocating into. So we're very much an active management firm. So when there's opportunities, we will actually go into those particular names.
Interesting. So there are, as the ETF space is proving itself to be, anytime there's a hot thematic, you're going to get a bunch of ETFs coming into the space. So there are a few other memory ETFs on the market. You got DRAM, you got Tuttle, now yours. How is your approach different than maybe the other memory chips ETFs on the market?
Yeah, so the first thing is we are more concentrated in the top HBM producers. That was our original goal. When we first launched it, SK Hynix was not as accessible. They actually listed ADR also in July, which makes it more accessible. However, what I would say is we still prefer actually buying the Korean security instead of the ADR because the ADR is trading at 25-30% premium to that of Korean. So we see some pricing differences. We actually add value, trying to arb that a little bit. It's hard to arb that, but there's some ways that you could do it. And then we are one of the I think, difference between us and a few other ETFs is that we can actually get the Korean denominated securities. And so some just focus on US securities, some focuses on some Asian securities. One of the, I think, difficulties is that Korean equity markets is actually highly regulated. It's largely open to institutional investors. You have to be registered to get those kind of exposures. So it took us a while to launch it, to actually get those access to get those securities when we think there's value. And then we have also access to other parts of Asia where a lot of the memory chip ecosystem is. So I think what we want to do is not just pick the right names, but from an execution perspective, get them at a price that makes sense for the portfolio.
Well, while we have like an extra handful of minutes, I just would, I'd love a refresher on KQQQs, which is your technology Titan Select ETF. It's been your flagship now for a while. In the beginning of the episode, you talked about getting growth, with income. Can you just give everybody a refresher on what KQQQ does?
Yeah, the KQQQ is also has a select in the name. So what we try to do is try to get exposures to some of the most transformative and essentially mega cap technology companies in the world. So this is the other end. It actually contains some of the hyperscalers that I mentioned, like Google, Microsoft, NVIDIA, etc. But the idea is that if you look at historical returns, which you have to assess whether that will repeat in the future, is that these technology companies tend to have done very well because they had compounded 15 to 20% growth for not 5 years, not 10 years, but for 20 years. Right? And the reasons that they have done so is because essentially they're monopolies. They dominate their particular verticals, and then they move to the next adjacent vertical to induce that growth. Because as a company gets larger, you expect the growth rate to slow down because they're larger part of the market. They can't grow anymore, right? Amazon dominate retail. They go to the next adjacent, they do AWS, et cetera, et cetera. So what we wanted to try to do is to get this essentially growth premium momentum that exists in these particular names. And most of these names do not distribute dividends, so we wanted to use options to generate income. However, we were also trying to solve a third problem. This is our kind of tech focus, is that most option income strategies underperform their underlying because you're giving up some of your upside to write option positions to generate the income. But we don't want to do that. We want to provide price appreciation and income. So 2 years down the line, I will say that we have kept up with the underlying and in fact outperformed it. And then it generates about 15 to 18% of distribution, depending on where implied volatility is in the market. And also, it's not just an exposures to the hyperscalers. Is technology company. We define technology companies as those companies that have used technologies to transform their particular industry. So there were moments where we had Oracle when they had the first pop from the data center built out, Netflix when they were growing subscribers, less so this year. And we actually were able to move from the mega caps to semiconductors this year. That's actually what's kept the portfolio outperforming relative to actually almost all peers in the category. So when we first came on the channel 2 years ago, we were talking about, we look at momentum weighting because that's a characteristic of tech. And then the perfect time to do cover calls or call spreads is when the underlying is moving sideways or downwards, and we'd be more tactical about it. So we've done kind of what we've talked about, and that's actually proven out to have good total return as well as good income distribution.
Yeah, and just to dive in that just a little bit deeper, one of the things that you do that's a differentiator to the other funds in the market, let's say like a JetQ, is you're only writing calls on names with limited upside or momentum. You're not writing over the entire portfolio. So why is that important, and how should an advisor who's listening to the show kind of understand that differentiation?
Yeah, so one big difference, we write option positions on single names. And then we have a basket of it. Versus if you write options on an index, you have the diversification first, then you have the option premium. So we think that actually first gives you more premiums that you can harvest. And then to answer your question, we think it's important that you're selective in terms of when you write the options, because not everything in the portfolio move in the same direction, right? So this year we've seen that Netflix has been falling ever since their announcement to try to acquire Warner Brothers. But really, I think people are maybe valuing Netflix less as a technology company than a traditional company. So it's been falling. But this is actually the perfect time in which if you write call spreads, or, you can clip the full coupon because the underlying never hits the strike. But versus it would have been a very poor choice. We do this with Microsoft this year, Google as well, because these essentially have been falling this year, right? It would have been a very poor choice if we had written calls on semiconductor names like Micron that's in the portfolio, or AMD, or etc., because you would have constantly capped your upside. So being able to, we're first and foremost active managers, so we have to have an opinion on the underlying, and then then it's the question of the implementation of those views, right? We can decrease the exposure for a name by writing a call, or buying a put, etc. And so we want to, in the truest sense in active management, collect the premium where we can fully realize that implied volatility and then distribute it as income.
Interesting. So how do you think about, between KMEM and KQQQs, how do you see these fitting together in investor portfolio? Do they complement one another? Should they be looked at individually? Like, how would you utilize these in an already diversified model portfolio?
Yeah. So I think a really nice place would be in an income portfolio. And most people, for KQQQ, it's actually a complement to other dividend equity ETFs. The reason we actually, it's a good complement is because typically dividend equity ETFs invest in high dividend paying names. And these are actually the slowest growing. We're actually going to release a paper about this. If you had just invested in dividend equity over the last 3 years, you would have gotten about 2% more distribution than S&P 500. S&P 500's distribution yields about 1%. Dividend equity is about 3%. You get a good pickup, but you would have lost out 20% in total return, right? Because most of the growth had been happening in tech, which is not what dividend equity portfolios invest in. So now you can pair up dividend equity with KQQQ. The combined portfolio actually gets closer to the sector weighting of S&P 500, and you get actually a 5% pickup from the combination of the two. So now it actually evens out your portfolio in terms of getting US large cap exposure. It's not just US large cap value now. It's actually almost like US large cap value plus US large cap growth. You get the full sector in the exposure. So we think this could be, KQQQ could be a core, a complement. And then KMEM, I will say, is more of a specialized view. It's thematic in nature. And US large cap already has a large part of technology, right? So this would be probably in part of your equity portfolio, but it would have to be coming out of your growth portfolio allocation. Yeah.
So what's next, Howard? I mean, we all, as an ETF issuer, we always have to be thinking about growing. Are you going to keep, are you thinking about keeping a very specialized view with these handful of ETFs and growing, or is there more that you guys have in the shop that we might see from you here in the future?
We have a lot planned. I mentioned we have income on precious metals, which it's another constraint people have in the portfolio management. But we're actually hopefully we can come back and talk about. We have some portable alpha strategies that we used to run at the large firms. Now we've actually made it even more tax efficient. They're what we call double-decker tax efficient. A lot of, maybe just to say, is that we're really focused on tax efficiency because US has a huge deficit and it's very hard to reduce costs. So the only way is to increase revenue. So we have a lot of strategies that are coming up that is very focused on giving you the exposures that you need in a portfolio, but in a very, very tax efficient way. So those are actually all coming out, in fact, in the last week and in the coming months as well.
Interesting. Well, Howard, I always learn something when we spend some time together. So I appreciate you being on. Before I can let you go, where can people learn more about your ETFs and Kurv itself?
You can go to our website, which is kurvinvest.com, KURVINVEST.com. And we don't just have fund information, but we also are publish our outlook and papers on how we think about these institutional strategies. So please go there for more information.
Well, again, thanks again for spending some time with me.
Thank you.